Title: SoV, MoE, UoA, The Unbundled Future of Money. Section 1. Introduction. For most of modern economic history, the functions of money have been tightly bundled into a single form, the national currency. Whether paper notes or digital balances, money served simultaneously as a store of value, a medium of exchange, and a unit of account. A US dollar or Japanese yen not only stored purchasing power, but was also the medium through which value was exchanged and the language through which it was priced. But that tight coupling is starting to unravel. Advances in decentralized ledger technology, combined with deepening geopolitical tensions, currency volatility, and the global shift toward digital commerce, are forcing a long overdue separation of money's core functions. In this new modular environment, different assets and different systems are emerging to specialize in each role. Bitcoin, tokenized gold, and commodity-linked units now compete to become the storehouses of trust and value preservation. Fiat-backed stablecoins, issued on open and programmable ledgers, are becoming the preferred vehicles of exchange. Meanwhile, local currencies, either physical or tokenized, still dominate as the reference point for pricing and compliance. This process, the unbundling of money, marks a turning point in the global financial system. It does not spell the end of fiat currencies, nor does it guarantee the universal rise of any single cryptocurrency. Instead, it signals a new architecture where each function of money competes independently for adoption, relevance, and efficiency. Section 2. The Classical Monetary Trinity. To understand what's changing, we must first understand what was unified. Historically, the convergence of store of value, medium of exchange, and unit of account was considered both natural and necessary. Gold served all three roles for centuries. Later, fiat currencies inherited that structure, enabled by state enforcement, centralized banking infrastructure, and global trust in sovereign debt markets. Let's define each function clearly. Store of value is an asset that reliably holds purchasing power over time. Medium of exchange is the vehicle through which goods, services, and debts are paid. Unit of account is the standard measure used to price and record economic activity. When these three functions align, the system is simple. You price in dollars, pay in dollars, and save in dollars. The global dominance of the US dollar as all three roles has made it the centerpiece of world trade, banking, and reserve holdings for over half a century. But this unity has come at a cost. It forces dollar dependency on other nations, even when misaligned with their domestic interests. It embeds monetary fragility. If one function breaks, for example, store of value via inflation, the others wobble. And it masks underlying inefficiencies, such as cross-border friction, currency mismatches, and exposure to foreign policy risks. As digital infrastructure evolves, it's no longer necessary or efficient for a single instrument to serve all three purposes. Section 3. The separation begins. Store of value breaks first. Among money's three traditional functions, store of value was the first to break away. The first fracture came from inflation and trust decay. Around the world, people began to lose faith in fiat currency's ability to hold value over time. This wasn't just due to hyperinflation in extreme cases like Zimbabwe or Venezuela. It was a broader, more subtle erosion. Even in developed economies, persistent inflation, low to negative interest rates, and rising sovereign debt made it clear holding fiat for the long term was a losing game. The 2020s cemented this perception. As governments engaged in monetary stimulus, debt monetization, and fiscal expansion, the underlying promise that fiat currency would protect purchasing power began to collapse. Central banks printed, markets rallied, savers lost. Bitcoin and tokenized gold entered as a response. The first true rupture came with Bitcoin, a digitally native, hard-capped asset with no issuer, no liability, and no need for permission. What began as a curiosity for cypherpunks morphed into a global store of value narrative. Its scarcity, transparency, and programmability offered a stark contrast to fiat dilution. Simultaneously, institutions began turning to tokenized gold, not for speculative gain, but for stability. Projects like Paxos Gold, or GBU, offered physically backed, ledger-native access to an asset with thousands of years of monetary history. These assets didn't try to be all things. They weren't mediums of exchange, too volatile, too slow, or too tightly regulated, nor did they operate as units of account. Few things are priced in Bitcoin or gold. Instead, they laser focused on store of value. And that clarity of purpose, monetary specialization, proved to be a feature, not a bug. Why most commodities won't compete. While Bitcoin and gold have emerged as the dominant store of value assets, most tokenized commodities won't succeed in this role. Why? Liquidity fragmentation. There's limited demand for tokenized silver, platinum, or copper outside of niche use cases. Narrative weakness. They lack the mimetic gravity of gold or the ideological clarity of Bitcoin. Storage and custodial complexity. Physical delivery matters for store of value assets, and not every commodity offers easy or trusted redemption models. In a digital world flooded with synthetic tokens, trust concentrates around assets with proven scarcity, institutional legitimacy, and simple redemption logic. Section 4. Decentralized ledger technology as the medium of exchange layer. Once store of value began to separate, the next layer to evolve was medium of exchange, and it did so on the back of decentralized ledger technology. Stablecoins emerged as the killer app for digital payments. Stablecoins like USDC, USDT, and EURC brought fiat currencies into the decentralized ledger era. They made dollars, euros, and other fiat currencies programmable, borderless, instantly transferable, and interoperable with decentralized finance, wallets, and smart contracts. Critically, these stablecoins decoupled medium of exchange from store of value. While still pegged to fiat, they didn't attempt to store value long term. Their purpose was transactional, to move money, not preserve it. Then came FX abstraction and atomic swaps. Ledger technology enables atomic swaps, real-time currency conversion without intermediaries. Combined with decentralized exchanges and permission compliance layers like licensed centralized exchanges with know your customer and anti-money laundering controls, this allows a customer to pay in USDC, a merchant to receive eTRI, all via real-time settlement even across chains. This abstracts away the friction of foreign exchange. It makes cross-currency commerce programmable, compliant, and cheap. Goodbye SWIFT and ACH. Legacy payment systems like SWIFT, ACH, and SEPA are slow, batch-based, and riddled with intermediaries. They were designed for a banking world that assumes weekdays matter, geographic borders are barriers, value transfer must be slow and reversible. Ledger-based rails flip all of that. They operate 24/7, 365 days a year. They offer final settlement in seconds. They charge lower fees and require fewer hops. And they're composable with applications and smart contracts. As more payment volume moves on-chain, ledger-based infrastructure becomes the default medium of exchange layer, regardless of whether the currency is issued by a government, a bank, or a regulated entity. Section 5. Unit of account stays local. For now, while store of value and medium of exchange are undergoing rapid reinvention, the unit of account has remained the most resiliently local, and for good reason. Legal tender, taxes, and cognitive simplicity all play a role. Most merchants, workers, and governments still think price and account in their local fiat currency, whether that's Ghanaian cedi, Turkish lira, or Argentine peso. This is not just habit, it's enforced. Legal tender laws require pricing in national currency. Tax liabilities must be settled in fiat, requiring accounting in that unit. Mental accounting is easiest when prices stay in familiar terms. Even when customers pay in USDC or Bitcoin, local merchants want to know how much that is in their own currency, because their rent, taxes, and supply costs are all denominated in it. This means the unit of account function remains anchored to jurisdiction, at least for now. The problem of menu costs. If a merchant prices in USD, Bitcoin, or GBU, they must constantly update prices to reflect exchange rates, asset volatility, and customer purchasing power. This is known as the menu cost problem, the overhead of updating prices in response to currency fluctuations. It's cognitively and operationally expensive, especially for small businesses. So even if global customers want to pay in crypto, merchants prefer to price in local fiat and let the system convert for them in real time. Jurisdictional stablecoins, and the return of the local unit of account. The solution? Locally denominated stablecoins. These are tokenized versions of national currencies issued by banks or licensed fintechs and held to a reserve standard, such as short-term sovereign debt or fiat deposits. Examples include ENGN for Nigeria, eTRI for Turkey, EGHS for Ghana, EURC for the Eurozone, privately issued Euro stablecoins under MiCA. These tokens give users a stable, on-chain expression of their own currency while being compatible with global ledger infrastructure. They allow merchants to price in local fiat, receive settlement in a local stablecoin, and accept payments from customers in any currency, all without breaking compliance, taking on foreign exchange risk, or introducing pricing confusion. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 6. Interoperability as the new monetary user experience. The most important and most underappreciated feature of this new monetary landscape is that users don't need to understand any of it. They just want this. I price in my currency. You pay in yours. The system figures out the rest. And that's precisely what interoperable monetary infrastructure enables. The emerging stack works like this. Wallets hold USDC, GBU, Bitcoin, eTRI for Turkey, or any supported currency. The payment layer can be decentralized, such as a DEX, or centralized, such as a licensed exchange with application programming interfaces. The conversion layer handles foreign exchange routing, stablecoin swaps, and slippage protection. The compliance layer ensures know your customer and anti-money laundering enforcement per jurisdiction. The settlement layer delivers real-time finality in a local fiat stablecoin. All of this can be embedded into web checkout flows, point-of-sale systems, mobile payment apps, or even smart contracts and decentralized finance platforms. So a Ghanaian merchant pricing in Ghanaian cedi can receive EGHS even if the customer pays in Bitcoin or USDC. A Turkish exporter can settle in eTRI from a Japanese buyer using GBU. This decouples payments from geography while still preserving jurisdictional compliance and accounting logic. Section 7. Implications for the dollar and U.S. Treasury market. The global shift toward tokenized stablecoins and decentralized rails is not just a technical evolution, it has profound implications for the U.S. dollar system and the financing of the U.S. government itself. Stablecoins act as shadow dollarization. Stablecoins like USDC and USDT are, in essence, offshore, tokenized dollars. They extend the reach of the dollar without needing the SWIFT network or U.S. banks. In many parts of the world, from Argentina to Lebanon to Nigeria, stablecoins functionally replace physical dollars. But unlike traditional Eurodollar deposits in foreign banks, modern stablecoins are increasingly backed by U.S. Treasury bills. This transforms them into indirect buyers of U.S. debt. Tether reportedly holds tens of billions in U.S. treasuries. Circle, issuer of USDC, holds reserves in short-term U.S. government debt. This creates on-chain dollar liquidity backed by off-chain treasury assets. So while the medium of exchange function of money detaches from traditional banking, it paradoxically reinforces demand for U.S. government debt. The Eurodollar exit goes on-chain. Traditionally, Eurodollars, offshore U.S. dollar bank deposits, fueled global trade and finance. But these deposits earned little or no yield, were trapped in fragmented banking infrastructure, and suffered from correspondent banking risk. Now, institutions and individuals can exit traditional Eurodollar systems, hold treasury-backed stablecoins, and gain programmability, liquidity, and settlement speed without intermediaries. In effect, Eurodollars are being converted into digital treasury bill wrappers. And this transformation is happening voluntarily because it's more functional. Why would anyone give up yield? That's a smart question. Why would someone convert a dollar deposit, which could earn interest, into a stablecoin, which may not? Here's why they still might. Payments over ledger technology are faster and cheaper. Stablecoins are liquid around the clock. They provide global access without capital controls. They are programmable and composable. They reduce counterparty risk, especially in weak banking jurisdictions. Additionally, new instruments are emerging. Tokenized treasury bills, such as USDY or other DeFi wrappers, offer yield directly. Yield-bearing stablecoins will eventually compete with traditional deposits. This creates a new demand surface for short-term U.S. debt, even if some of it flows through crypto-native intermediaries. The net effect is disintermediated support for U.S. debt. In the old system, banks held treasuries, depositors held claims on banks. In the new system, stablecoin issuers hold treasuries. Users hold tokenized claims directly on those treasuries via stablecoins. The U.S. government may lose control over the distribution of dollars, but it gains sticky demand for its debt, so long as stablecoins remain treasury-backed and legally permitted. If anything threatens that status, such as regulatory overreach or competition from non-dollar stablecoins, Treasury bill demand could fracture and U.S. borrowing costs could rise. In other words, the dollar as medium of exchange may erode, but the dollar as collateral may strengthen, at least for now. Section 8. The future monetary stack. The trajectory we've traced, where store of value, medium of exchange, and unit of account split into specialized roles, leads to an entirely new modular monetary architecture. This architecture is composable, interoperable, jurisdiction-aware, and programmable. It is no longer a world where one currency must do everything. Instead, the monetary stack becomes layered, with different assets and tools fulfilling distinct functions, optimized for context. Let's break it down. Layer 1. Store of value assets in this layer include Bitcoin, tokenized gold like Paxos Gold or Goldbit units, and possibly commodity baskets. The purpose is to preserve wealth over time. Attributes include supply caps, trust minimization, liquidity, and global accessibility. Examples: a Latin American investor holding Bitcoin to hedge against inflation, a central bank allocating reserves into tokenized gold. Layer 2. Medium of exchange assets. In this layer include stablecoins such as USDC, USDT, EUROC, eTRI, ENGN, and even tokenized central bank digital currencies. The purpose is to move value frictionlessly across networks. Attributes include fiat pegs, permissioned or permissionless issuance, high transaction speed, and programmability. Examples: a business settling cross-border invoices in USDC, an African freelancer receiving payment in a local stablecoin like ENGN. Layer 3. Unit of account assets in this layer include local fiat currencies like the Ghanaian cedi, Turkish lira, or Argentine peso, digitally represented through compliant stablecoins. The purpose is pricing, accounting, and taxation. Attributes are jurisdictional, regulated, and native to local mental frameworks. Examples: a Turkish merchant pricing goods in lira, even when receiving USDC. Tax authorities requiring income reporting in pesos. The cross-layer coordination infrastructure. What makes this stack work is the coordination layer, the invisible plumbing that handles foreign exchange, compliance, and settlement logic. This includes decentralized exchanges and liquidity routers for real-time currency swaps, know your customer and anti-money laundering providers that enforce compliance per jurisdiction, wallets and point-of-sale terminals with smart conversion user interfaces, oracles to ensure accurate pricing, yield rates, and regulatory thresholds, identity protocols to track legal obligations across borders. This is the layer where innovation will concentrate and where competitive advantage will emerge. Borderless, yet legally aware. In this stack, borders are abstracted, not ignored. Transactions can span jurisdictions, but settlement respects legal tender requirements. Stablecoin issuers comply with local reserve standards. Merchants receive value in the currency they are legally obligated to use. This is what makes the future monetary system both permissionless and accountable. From monolith to mesh. The legacy financial system was monolithic: one bank, one currency, one jurisdiction. The future system is a mesh. You price in one currency, you store in another, you pay with a third, you settle through a fourth party, you route via a fifth network, and it all happens in milliseconds, abstracted behind clean interfaces. What the internet did for communication, this stack will do for value. Section 9. Conclusion. The monetary trinity, reborn as infrastructure. The traditional unity of store of value, medium of exchange, and unit of account is not being destroyed. It is being restructured. Where once a single national currency had to bear the burden of all three roles, we are entering a world where each function is delegated to the best tool for the job. Bitcoin and tokenized gold serve as the sovereign resistant stores of value. Stablecoins, running on decentralized rails, function as global, programmable mediums of exchange. Local fiat stablecoins preserve legal compliance and pricing clarity as the default units of account. This separation isn't a breakdown, it's an optimization. It allows individuals, businesses, and even governments to hedge inflation risk without abandoning their national identity, transact globally without sacrificing local legal structure, and price natively, store safely, and settle flexibly. In this modular system, the monetary trinity becomes infrastructure, a stack of interoperable components, composable by design and adaptable to the user's context. Final thought. The unbundling of money doesn't end in chaos, it ends in choice. A Nigerian merchant can price in Ghanaian cedi, store in Bitcoin, and settle in USDC. A Turkish buyer can pay in tokenized gold, while a Ghanaian seller receives a local stablecoin. A European investor can hold a euro-denominated yield-bearing stablecoin backed by German bonds, while transacting on a decentralized finance platform priced in dollars. This is no longer science fiction. It is functional reality emerging at the edges. The question is no longer whether the monetary trinity will unbundle, but how we will design, regulate, and interact with the infrastructure that follows. The future of money is layered, programmable, and sovereignty aware, and it's already being built.